Well, drop the prepayment penalties and stretch out repayment plans. And they're just a couple of the ideas the Federal Reserve is proposing to help strapped homeowners. But is the damage already done, and does the Fed risk doing more harm than good, and worse after the fact? Trust me, when it comes to the government, oftentimes it's not the disease that'll kill you, it's the cure. Is it this time as well? Let us ask Jonathan Hoenig, Tracy Burns, Fox Business senior economist Mark Lieberman, and mortgage lender Chip Cummings, the author of Mortgage Myths. Chip, to you first. You're in this industry. You know this industry. Are you worried what the Fed is proposing for your industry?
Not really. This is stuff, Neil, that they probably should have done a long time ago. I mean, it's not going to help anybody in today's foreclosure situation, but there are some real good things that the Fed's put in place that are going to control things like escrow accounts, taxes and insurance, prepayment penalties.
In other words, to make that more transparent so people know what's out there, right?
Exactly. Another area being, advertising. You've got some deceptive advertising out there, and this will help clean that up.
You know, Jonathan, the only thing I worry about are some of the other provisos in that measure, and that is removing prepayment penalties and the like. I think that's great if you're a customer, but if you're a lender, in the future, you might look twice at lending, right?
Yeah, Neil, that's exactly right. I mean, the net effect of all these regulations will be to raise borrowing costs for everybody. It's going to tighten credit and make it harder for everybody to get a loan. And essentially what it is, it's a cost on the industry. I mean, this notion that the lender has to verify the borrower's income, that is a you talked about, that is a cost to the industry. That adds up to drive capital from the capital markets and make it more difficult for those, especially those who used a subprime loan responsibly, to get a loan. Next time around, they won't be able to get any loan at any price. You
know, Mark, it comes to a basic point for me that with the best of intentions, the animals have left the barn.
Oh, absolutely. I mean, and the Federal Reserve proposals this morning won't help the situation at all. In fact, as we just heard, it will dry things up.
What do you think happens?
For starters, without prepayment penalties, the market becomes less liquid. I mean, the mortgage market has worked because of agencies like Fannie and Freddie, which have been able to sell loans to investors who expected a specific return. If the loan gets paid off early with no prepayment penalty, the investor faces something that's considered reinvestment risk. Where am I going to put my money now to earn the same return? So it doesn't make any money. It dries up capital that flows into the mortgage market and does, in fact, make it more difficult for people to borrow.
Tracy, I was talking to a very prominent Republican today who was telling me, Neil, I'm not all for a lot of these governmental moves. But we got to do something because the people seem to be demanding we do something. What do you make of that?
Well, I think it's because they're down and they don't know what else to do and they're turning to their government. And then, of course, we have this little election going on. That doesn't hurt things. I think in this situation, though, we have two different constituents. You have the people borrowing the money and the banks. And as, we're talking, the banks are going to get really hurt by all this. On the one hand, the consumer, I guess, ends up better off if he doesn't have to pay prepayment penalties, and the fact that he has to justify his income will probably help him at the end of the day, prove that he could actually handle the loan. But the banks are going to get hurt by all this, and that in turn then hurts the economy. So I think it's a very fine line for the government to get involved here, because while they think they're helping one hand, they're hurting the other.
And Chip, that's what it comes down. I know you like a lot of these ideas. Here's what I worry about. It's a lot like Sarbanes-Oxley, which was supposed to clean up corporate crookery, for want of a better word. Right. And so, the 90% of the companies out there that were doing the right thing are paying millions of dollars a year to put on paper they're doing the right thing for the few who were doing the bad thing. And it I think, becomes an administrative nightmare. What do you think?
Well, it does, and you're right. I mean, there's a fine line there, and lenders are taking the hit right now. Some of these loans, they shouldn't have been in place. When you have a Burger King employee stating that they make $25,000 a month and you don't have to verify it, that's a problem. This is just
I tried that in college and it worked. But go ahead. You think that's a bad idea?
Well, it's worked for a lot of people, Neil.
Right.
But the problem is, yeah, there's going to be some more paperwork and there's going to be a little bit more cost. But it's protecting the lender and the public in the long run, because right now we're looking at the government having to bail this out, and frankly, that's not their job.
But Chip, why does there need to be any sort of bailout? I mean, aren't the lender and the borrower responsible for their own actions? And what business is it the government's to bail anybody out from a bad investment decision?
Well, they are, and it's not, but it's their job to protect the banking structure, so to speak. And when you've got it penetrating the banks, where Citibank's got to go overseas to borrow $7.5 billion, you've got to take some steps to protect the cash flow into the system as it is. Now, systems like the FHA Secure program and the regulations that the Senate just passed, that's going to help borrowers right now. And it's
well,
going to
I'm all
provide
for
an
the
underlying
transparency
foundation.
part, Mark, but the other stuff kind of worries me.
There's another issue here, I think, that first of all, the Federal Reserve doesn't have an enforcement mechanism. So this becomes toothless. The Federal Reserve, in fact, said in the statement it will be relying on the other banking regulators to enforce this. But for those issues where the Fed can, in fact, oversee, we're going to have the Federal Reserve come in, look at a bank, and say, yes, you're complying with all these rules, and put a sticker on the door, a seal of approval, good housekeeping seal, if you will, that says this institution has been inspected by the Federal Reserve. Then you come along to get your next mortgage loan, and you say, it's a Federal Reserve approved institution. They're certainly going to do right by me.
You think it gets worse or better from here?
I think the markets were crying out for this. The markets were in a slump. They just were pouting.
Yeah.
Nothing was helping them. And now, as you're saying, we have a little regulation. Maybe it'll make them feel better.
All right,
But it didn't help the banks. It didn't help the banks.
Not
Neil.
today at all.
You know,
They got hammered.
very, very good point. Guys, I want to thank you all.